Let's start off with how are you approaching business in FY19, and how do you think that the conditions will be different this year as compared to last year?
See, as far as we are concerned, we believe that this financial year 18-19 should be better on all parameters. We will have more launches, we will be entering into a new city, and both our verticals, real estate as well as the contracting part, should show growth. We believe that our interest cost should still remain reasonably well under control. Interest rates should remain well under control, should be lower than what we have paid in the last financial year. And overall, the balance sheet should show some kind of a healthy growth in line with what we have achieved in the last financial year. As far as the environment is concerned, the Bangalore environment, where we are a key player, Kerala and in Gurgaon, we continue to see traction, sales are happening. Overall real estate market, despite whatever incentives and whatever good things which have happened in last few quarters, still it looks to me it's sluggish on the residential space. On the commercial space, it continues to do well. Maybe that demand supply mismatch and somewhere some uncertainty in the minds of the customers in some other locations, it is affecting. But that also gradually, what we are seeing with the new launches becoming less and less and sales happening, that scenario also should improve.
Now, talking about Q4 numbers, the market was slightly disappointed with the margin levels that you reported. One is what caused the dip in the margin levels, and going ahead, what can be sustainable margin levels that the market can watch out for?
I think market has its own dynamics to interpret or to correct or not to correct. Our margins have been better. We had a revenue stream of contracting which was higher, almost 35% for the quarter against 28% or so for the whole year. The contracting division has lesser margin than the real estate residential space division. So it had some minor impact, but net at the gross level or at the net level, we have had the better margins than the last financial year, that is 17-18 versus 16-17, and going forward also we believe that our margins not only will sustain, they will be far better than what generally you see in this sector.
Mr. Sharma, can you give us more details on the 6 to 8 project launches that you have announced in the Q4 presentation? What is the area under development that you're looking for? What sales value are you expecting? And what will be the timeline of completion of these projects?
Almost 8 million square feet of new project launches we have lined up. The launches should start from the next month onwards. They are at various stages of what you call that process of launching, the sales, marketing, re-registration, somewhere some final approvals, etc., etc. And this is what we are banking upon in this financial year, that these launches should help us to improve our sales in this financial year. As far as the completion part is concerned, normally we are taking almost 4 years to complete a project, and we will be taking the same quantum of time to complete these projects which we are likely to launch. The Bangalore will witness highest number of launches, but we will have launches in Chennai, we will have launches in Cochin, we will have launches in Pune, we will have launch in Mysore, and in other cities as well.
Mr. Sharma, despite the fact that in Q4 you reported healthy growth in the sales value and the volume numbers as well, there was a net decline in the realizations front. So does that mean that sales happened in the low cost projects, or was there more discounts that were offered to the customers?
No, it is not the correct and factual interpretation. If you look at, we realized 7,993 rupees per square feet for our products in the last quarter. And our share was 6,457 rupees per square feet. What has happened is in the last quarter, while selling more, we have also sold the partners' shares as well. So because of that, while recognizing the revenue part, what was not belonging to us, we have excluded, and on that basis, you see in the last quarter, small dip. We are not giving any incremental discount. Rather, in some of the projects, though in a very, very small manner, but still we find that we are in a position to push small price increase in those projects.
Mr. Sharma, one final question on the contractual business. Can you give us a sense of, where do you expect the contractual business to be, not only in FY19, but in FY20 as well?
See, we have a beautiful backward integration model. And when we started contracting division, we were only working for one single client for the first 10-12 years. That was Infosys. But in last 6-7 years, we had diversified and we have developed a good stream of income, where last year we did almost 850 crore of billing in the contracting side. We have won some new orders. Our order book currently stands at 2,500 crore or so. This quarter we see significant improvement in our contracting margin as well, and going forward to the next financial year 1920 also, we should be doing better than this financial year. So at least from the visibility perspective and the clarity perspective, these two financial years definitely will be showing maximum growth on the contracts and manufacturing side.